Welcome to Candid Conversations for Financial Markets podcast series. I'm your host, Laura Paglia, President and CEO. Our podcasts are designed to provide insights, transparency, and provocative yet achievable proposals for matters that move financial markets in Canada. Today, we're having a look at corporate spinoffs, known in Canada as butterflies, and why they matter for national economic competitiveness. We are delighted to have with us Manu Kakkar, President, Kakkar CPA Professional Corporation. He has over 25 years of experience in taxation, both domestic and international, including personal and corporate taxation, as well as litigation support. He runs an independent tax practice and acts as counsel to clients across a wide range of industries in Canada and in the US, with a focus on domestic and international reorgs and transactions. He is recognized for his expertise in Section 55 of the Income Tax Act and butterfly reorgs in Canada. He has lectured at the CPA Canada programs, the Canadian Tax Foundation, the Society Trust and Estate Practitioners, and various provincial accounting bodies across Canada. He has served on a number of conference and program committees associated with CPA Canada and the Canadian Tax Foundation, including the Canadian Tax Foundation's Ontario Tax Conference. He's also served a 3-year term on the Canadian Tax Foundation's Board of Governors. Manu sits on the CPA Canada Small and Medium Practitioners Tax Committee. He has been appointed to the CPA Canada Bar Association Joint Committee on Taxation for a 2-year term. He is also the author of A Critique of Canada's Divisive Reorganization Rules. Should breaking up be so hard to do? Welcome, Manu.
Well, thank you very much. I'd say half of that is true. No, I'm just kidding, Laura. So thank you very much, seriously, for having me on. It's a pleasure. I'm very much passionate about tax reform in terms of trying to simplify policy objectives. And this is an area with the thesis that you mentioned, which I wrote, I guess it's a golden oldie, close to, 25 years ago. I don't want to mention my age, how old I am, but that it is a passion that I've had as to why butterfly reorganizations, which let's say one that we're talking about today is a corporate spinoff. Why should breaking up be so hard to do? And we can kind of talk about that today. And I'm hoping to bring forth policy change that's in line for the betterment of the Canadian economy. So hopefully I'll be able to help today. And thanks for having me on this podcast.
And we are delighted to. So why don't we start with, what is it?
Okay, so I'm going to explain it in layman terms. And what happens is, let's say I'm wearing a suit today and I'm wearing, let's say, pants. And I put, very conceptually, I have a dollar bill and I have it in my left pocket. So then I decide to move the dollar bill from my left pocket to my right pocket. Then I decide to move from my right pocket to my jacket pocket. And what happens is, wherever the pocket is that I have this coin, I shouldn't say dollar bill, I'm dating myself, but let's say a coin, a loonie, right? It's under the same person. It's me, right? But I'm just choosing to put it into different pockets. And as easy it is that I'm just moving it from left pocket to the loonie, from a left pocket to left pant pocket to right pant pocket to jacket pocket. That's in a way when we go to corporate spinoff, that's what it is. So what we're saying with a corporate spinoff is that if we have the same group of shareholders, let's not, now from tax perspective, which we're going to get into later on, about there's related party, let's say shareholders and unrelated party, but let's say same group of shareholders. We're doing the same thing. We're just taking a company that could be created as part of a spinoff or that already exists and move it to a different pocket. It's basically going to be, instead of being owned by, let's say it's the same group of shareholders, I may want to move it to another company owned by the same group. So let's say we have, very simple example, company A, and company A is, let's say, widely held, and we decide to move it from another subsidiary from company A to company B that's owned by the same widely held people, right? That would be a spinoff. We're just moving it around and spinning it off. So that is kind of an example, high level. We're going to get the specific examples when you use a spinoff, but that's an example of where we could see a spinoff, basically, right? That's one example where we would be able to see it. So that's sort of what is a spinoff is. You're just moving assets into a new company or an existing company from a group of shareholders, that's a company controlled by a group of shareholders, to the same company controlled by another group. And we're going to get into, I guess, like when do we see it, and like whatever. But that's high level. And I hope the explanation of kind of what is a spin-off, just with my pocket analogy, that's sort of what we're doing. So just imagine we're just transferring assets among the same group of shareholder in a corporate vehicle. And there's other reasons we may want to do that, which we'll probably get into later on.
Oh, so thank you. So you mentioned reasons you would want to do that
Yeah.
in companies.
Yeah. Yeah.
So if we just skip ahead a bit to the
Sure.
benefits of these corporate
Sure.
spinoffs.
Sure. That's a great question. So there's a couple of benefits we can think of for Canadian capital markets, and one of them would be, like, let's say for instance we have a spinoff where, let's say, we had a building. We'll give like simple examples to explain why. So let's say one would be whereby you have a building in a company, and you want to spin that off among the same group of shareholders to an existing sister company, so that we want to basically, because what happens is when we sell companies, operating companies, is usually, especially high growth companies, it's a function of EBITDA, right? And if you have the debt in there with the mortgage associated with the real estate, that would depress the value of the operating company artificially, because you have a building associated. So a common corporate spinoff would be, well, I'm going to have the same group of shareholders. Instead of having one company with a building and an operations in, I'm going to spin that off into another company, a sister company, a company B that's owned by the same group of shareholders, so that now we have, if we want to multiply and value the operating company, it's not being skewed. If we want to sell the operating company without the building company in a Wiley group, we can do that, because sometimes, a lot of times, we don't have, let's say, capital markets, the buyer, whether it's private equity, whether it's another pubco, whether it's a foreco. I mean, sorry, foreign. So I'm using the analogies like foreign company, a CCPC, Canadian private company. They may not want to buy the building, right? So you're doing this as a way to separate different assets that may have different investors, that may have different divisions, right? So that's one aspect where we would do a butterfly. That's one aspect, or a spinoff. Like, that's one example. Another one would be, let's say, and ironically today, we visited two clients where we're in the current process. I know this is like, in Hindi, we use the word kismet, which means fate, that they're actually in the middle of doing butterfly reorganizations. And a lot of them have foreign investors, which is part of your thing about comparing it to like foreign spin-off provisions. The other one would be, let's say we have two divisions in a company, A and B, and I want to explore different growth opportunities, different investors, different seller buyers. They're two different divisions. They have different synergies, different market potentials, right? I want to, right now, if you're commingling in the same company, it's difficult to value each division. If I have an investor that wants to only invest in division one, not division two, I can't do that unless you're getting into complexities regarding tracking shares and all that, which we don't want to get into. So we would take it in either a public scenario or a private company scenario, spin that off into another sister company. So instead of having one company with division one and division two in it, you have company one with division one, company two with division two. Now we have a situation whereby we did this for a client. Client wanted to explore new partners with division two, but keep division one for itself, right? So keep division one as a keep asset and have division two as a sale asset. We can do that now that we did a spinoff. Now, there's obviously technical rules that you can't, about the timing of when you can do it on an ultimate sale. But now, if we hadn't done the butterfly or the corporate spinoff, right, with this particular client, live Canadian company, it's a growing Canadian company. We now had buyers come in for the division two that only wanted division two, not division one. And the original founders never wanted to sell division one. We would not be able to do that had we not done the spinoff, right? And this is like a widely held private company. It's almost like a mini public company scenario. And we were able to do it, right? That's sort of the second reason there. And the other reason is that you might just want, for, again, let's say you have a large public company group, you have an existing company, and you just want to, that same company, you don't have different assets in it or whatever. So the first two we gave are sort of what we call bifurcation, I think bifurcation of assets, corporate spin-offs. You're taking assets from an existing company and moving it out. The other one could be is that we're just transferring we're transferring existing company from one related group or unrelated group to the same group to another entity. Why? Because we want to clean up the corporate structure. We want to, maybe, let's say we have this company in a group of companies owned by the same group of people, because that's what spinoff means. You have the same shareholders before and after the transaction. Whenever I move it, company 8 or whatever it is, from one shareholder, it's the same group of shareholders. That's what's called a spinoff. You're not, and that's the example I gave in my pocket, my Loonie pocket. If I move my Loonie from one pocket to the other, you'd agree with me, Laura, it's still owned by me. It's just different. I'm just in different venues. So a lot of times we'll see is, let's say, corporate simplification, where we're saying, well, this growing company is underneath a group of shell companies that I want to eventually amalgamate or get rid of it and wind it up. but I want to then move this active company from this, let's say, dormant companies into an area where there's companies that are growth companies that we could sell. So it's just like a corporate cleanup we're doing. We're just moving it across so then I can clean up the other companies, right? That's all I want to do. I want to get rid of it, wind it up, but I can't wind up companies if that are active, right? Because there's tax consequences, like they're more difficult to do, right? So these are a lot of varieties. Like, and if you look from a policy perspective, right? We're not doing anything wrong because I have the same shareholders or group of shareholders at the end of the day owning everything. That's what the spinoff is. We're just doing it for economic reasons, right? And so a lot of times, like I'm a believer that if you have a business reason for doing something, right? And you're not being mischievous, and we're not going to get into the technical details of being mischievous from a tax perspective today. But if you're not being mischievous and trying to save unduly amounts of tax, and these spinoffs are really what's called tax deferral vehicles, so that we're just avoiding corporate tax, right? That's all we're trying to do. We're trying to avoid corporate tax by doing cleanups for business purposes. Then there should be no reason why we should be prevented or it should be so difficult. Hence the name of my thesis, why should breaking up be so hard to do? That was a pun, by the way, on an old Beatles song. That's the reason why, and that's sort of the driving force as to why I'm passionate about this cause. That it shouldn't be so difficult to do something like this because they're for economic reasons. So I hope that I clarified. Those are three examples that come top of mind to me. That when you would do a corporate spinoff, like what are the benefits? Like, it's sort of like what are the benefits of, like we saw it here with the different examples. Is more practically, it's a when would you do it? And these are examples, and they're more of when you could do it. And I think these are common examples you can see that make sense. We're doing it for business reasons. There's various reasons we're doing it. So yeah, go ahead.
Oh, so thank you very much, Manu. It shouldn't be so hard to do. Would you be able to explain how it works in Canada in simple terms?
Oh boy, Laura, you ask tough questions. So I'll be frank. The reason that's a loaded question is it's a great question, by the way. Like no, nothing personal. Is that's the problem? It's that it's not simple to do. It's not simple to do. It's complex to do. And kind of what I'll do is I'm going to sort of jump into I'm sort of going to combine this with sort of adding in sort of like how does it work in simple terms to sort of combine at the same time, if you don't mind, like kind of, I'd like to say, what are the friction points or the pressure points in the Canadian SaaS when it comes to executing these transactions? If you don't mind, I'd like to sort of commingle that together because it kind of melds together and it'll be easier to understand. Okay. So the issue is that and I know you have a corporate law backgrounds. I understand and I think a lot of viewers will be sophisticated. Let's say we want to put two companies together, right? It's a merger, right? And imagine a statutory amalgamation, right? You file forms, you file legal documents, company A, company B, we want to merge it together. So simply put, we have yellow Play-Doh and blue Play-Doh. We want to mix it together. We get green. And we merge company A and company B together. It gets company C. Yes, there's legal work to do, but it's legally easy to do. From a tax perspective, it's easy to do. We get a rollover on an outside basis, meaning the shares get, the old shares get disposed of for tax purposes at cost. New shares get back at proceeds of disposition. Inside basis, meaning that any of the assets that we have that could commingled or pooled together on the amalgamation, it gets rolled in at cost. There's no tax consequences to this, which everyone knows, right? Because otherwise, if there were tax consequences, now there are if it's badly implemented, but assume it's properly implemented, there's no adverse tax consequences. Otherwise, this would not be a common transaction because everyone heard of the word merger. What we're doing here with the spinoff, in a way, is a demerger. Like the first two examples in particular that I was dealing with, where I'm extracting assets out, like I'm taking a building out as a spinoff. I'm taking a division out so that we can have different growth opportunities, which is kind of common. It's not that uncommon where you can start one company, you have two different companies, two different divisions. You want to spin one out so that you can have different growth opportunities, or we want to spin out an asset from an existing company to another company. Just for, we want to, because that other group of companies, which is owned by the same group of people, has more growth opportunities than the existing company where our company's under. The problem is that there's no simple legal and tax mechanism to do the demerger in Canada, which doesn't make sense because you'd be thinking, okay, like you're not a tax person. People are smart. People say, oh, I'm not a tax person. They oh, Manu, this is complicated. I go, no, you're smart that you're not in tax. That's what I say to people, that you're not a tax person. But it makes common sense. Like you could put something together and merge. Shouldn't you conceptually be able to demerge if you have the same group of shareholders? Yeah, you should. Right? That you should. But the problem in Canada, and I'll explain to you why, is there is no demerger mechanism like you have in the US, like you have in France, for instance, because I deal with a lot of these countries because of what my client base is there. You don't have that simpler version to demerge, which you should. There's a missing tax deferred rollover in the act. That's your problem. It doesn't exist. So we call it a butterfly. And people can ask me, well, why do you, I mean, me made me say, why do they call this thing a butterfly? Like, that's the thing, and I'll explain it to you if you really want to know the reason. It's a funny story. It's not, there's nothing technical about it, but there's a funny story about it, which if you like funny stories, I could tell you. So, and I'm sure so what happens is the way this came about is that for tax purposes at a corporate level, right? If company A sells company B, we get a capital gain. Okay. It gets taxed at 25%. However, if company B pays a dividend, and assume that dividend is coming from safe income, which is basically the retained earnings of the subsidiary. Let's assume that happens. That dividend intercorporate is tax-free. So at the corporate level, we are very biased to try to convert a capital gain into a deemed dividend or a dividend because I can get potential tax-free treatment. So what happens is there's a very funny rule of the act, which is called subsection 55(2), which you said I'm supposedly an expert on, and I guess my ad people are giving good publicity to me that they say I'm an expert on. I know a little bit about that. 6055 will say, no, we're going to convert that dividend if you run afoul of our rules into a corporate capital gain. It's one of the most difficult provisions of the act. And so what a butterfly is, it's a way, it is a divisive, it uses divisive reorganization provision. The way we do it, and I'll explain to you conceptually how it works, but it in itself is not really a demerger reorganization provision at all, like you have in the US under IRC Code 355. It's an exception to an anti-avoidance rule that says, yeah, if you're doing some funny business, I'm going to convert that deemed dividend intercorporate into a capital gain, right? And so a divisive reorganization, or one of them are called, one of the divisive reorganizations is a corporate spinoff, is an exception to a bad rule that would convert an intercorporate tax-free dividend into a capital gain. So there's your problem. How we're using these butterflies, and it's really simple. If I say, hey, Laura, come to my house for dinner, you're going to enter through the front door. But I have to say, Laura, you know what? The front door is barred. Go be like Mission Impossible, right? And basically go upstairs, go run around my backyard, go into my deck, climb up a ladder like 5 steps, jump into my attic, and then climb down another set of steps to meet me in the front. It's a little bit more cumbersome to do, but you're getting to the same spot. So similarly, what we have to do, because the butterfly reorg provisions or whatever we have are basically using deemed dividend provisions. It's creating cross redemptions, right? So what ends up happening is, as part of the structure, when we move the shares or assets over to a new company, we have, let's say we have the original shareholding owning shares in the other company and the new company owning shares in the original shareholder. We cross redeem or get rid of or cancel these shares. And when we cancel these shares, we're severing the tie between the old parent company and the new parent company. So that's where the asset moves. And the issue is that when we sever the ties, we got to worry about, are these deemed dividends being subject to Section 55 and get converted into capital gains, instead of just having a straightforward, hey, let's just get the demerger done other ways. So it's like, Laura, I'm asking you, when I'm doing a corporate spinoff, to go back in the back door. So I'm coming instead of the front door of my house, I'm telling you to go to the back door, climb a set of ladder, go through the attic, and climb down another chimney. And when you're doing that, right, if you're doing something that should be done like in the US in 2 steps, in Canada, this is potentially done in anywhere from 6 on a simple butterfly. And I've used the word simple very loosely, right, because butterflies aren't simple. On a simple butterfly, you're looking at 1, 2, 3, 4, 6 steps, 5 to 6 steps instead of 2. You're multiplying risk, right? You're basically using provisions of the act that are not meant to be used to split the demerger an asset or demerger a company for something else. It works. It's clunky, but there's more risk associated, because if I screw up on the deemed dividends, when I have to cut the tie between the 2 companies, the original, we call it distributing corp, and the original, the subsequent transferee corp, which is like, let's say the 2 parent companies, I can get those deemed dividends subject to capital gains at 25% each. So my risk on this butterfly is, if I screw up, it's potentially a 75% corporate tax, where my normal corporate tax on capital gains is 25. So that's kind of conceptually why that's kind of how it works. And the ironic question is, say, how does it work in simple terms? Well, it's not so simple, and you can explain why. That's the reason why. So we're missing a demerger provision in the act. It's a missing rollover provision. We have an amalgamation, but we want a demerger provision, right? Or like a de-amalgamation provision. And sort of what I want to touch on now is, and we were talking about this, is that, well, when we're doing corporate spinoffs, like, this is to me another question, just for me, if you don't mind jumping in and asking myself a question, is that, what are the pressure points you have in doing in executing this transaction? And that's what the problem is that you don't have a one size fit all approach, right? you basically have three types of spinoffs. Like, when you go to Baskin Robbins, I don't know if you have kids, I know you have kids, and I don't know if you guys kids take them to ice cream, and there's 39 flavors of Baskin Robbins. Well, in Butterfly, we can potentially have 45 different flavors of butterflies, and there's three main in spinoff. So when we do, in the spinoff family, there's at least three main types of ice cream, which doesn't make any sense because, like I said, the policy objective is the same. Why are you having different types of corporate spinoffs for different types of groups, which is another problem. So the first issue is if you have a related group, let's say I own everything. The spinoff can be done in an easier way, right? It's sort of like we don't have as much restrictions involved. And if instead, let's say we're doing it in a public company scenario, it's not as easy as if it's in a related party scenario. But in a public company scenario, you basically have one type of property in the company you want to spin off, and you spin it off. And you'll explain to me why the types of property tests become important. So it's easy because what we're doing is, let's say we want to spin off a division from a pubco into another pubco. It's easy because all you do is say, well, you have one type of asset. I want the division one has basically is worth 2/3. Division two is worth 1/3. I'm going to spin off 1/3 of the shares over to a new company, move 1/3 of the assets, tickety boo, there you go. The hardest one, which is not good from a policy perspective, is when we deal with small businesses. That's the hardest butterfly to do, which makes no sense because and that's what I said. This is what my thesis was about, where I was saying, listen, if most of Canada, you'd agree, Laura, are based of private companies. We're a private company-based economy. We have some pubcos, but it's not like we're not a pubco-dominated landscape economically. We can have large private cos or CCPCs, Canadian Controlled Private Corporations. But ironically, do a butterfly for these companies where they don't have the budget to do a butterfly. It's hard anyways. It's the most complicated, which makes no sense. Why it's complicated is because you have, in the terms of types of properties you can butterfly, you have three types of properties. Instead of in public company spinoffs, you have one. So if I have a division, like I had like today with this client, where we want to spin off division two into a new company owned by the same shareholders, the problem was I had three types of property: cash, business assets, and investment assets. If I do the same thing in a public company, we're doing divisions, we don't have that. We have one type of property. It's easy. So we do simple math. So what we have to do now is take the balance sheet of the private company and basically say, well, we're going to take the cash on the day, divide it 2/3, 1/3, right? And I'll give you why this example, it's kind of absurd, but explaining why it's complicated. We're going to take the business assets and divide it 2/3, 1/3. 1/3 we spend, 2/3 we keep. And then we're going to divide the investment assets and then keep 2/3 and spin off 1/3. What's the problem? You say, little money, what's the problem with that? Well, let's just say I was doing recently at Butterfly worth about $500 million of real estate. Okay, $500 million. We have to get an advanced tax ruling, took 2 years, right? So the real estate, which is, let's say, assume the business assets are worth $500 million, and I want to spin 1/3 to somebody and 2/3 I keep, right? Let's say I want to do that. Laura, here's my question I got to ask you, if you don't mind me asking you a question. So let's say now I say, okay, I want to, and let's say the cash on hand, right, is, and I'm just doing this to make the math work so you understand why I'm doing it, is $3.33, the cash. So if I take 1/3 of that, Laura, how much is that? If I have to, because I have to take 1/3 and move it to the other company, that's $1.11. And I keep $2.22. Now, here's your problem. Cash moves. How are you going to get the cash right? Because it moves. So you're going to have to project. So what you have to do is now freeze the accounts on the day of the butterfly and then move it. And guess what your margin of error for that CRA gives you? You want to guess?
0.
1%. So means is that on a $500 million butterfly, which we're doing for various business reasons, where I'm doing 1/3, that's the business assets. If I'm off by 1%, and let's just take a calculator here and say $1.11. See, we work here in tax, so at 1%, I can only be off by a penny on when I spin. If on the cash, on a private company scenario, let's say I spin $1, I move $1.13, so it's off by 1 cent. There's a 75% corporate tax on a $500 million butterfly of real estate. Does that make sense to you? No, it doesn't. Because it's like, why would something like that? And so it's opposite. You think, okay, in a private company scenario where you have unrelated shareholders, right? That's the most complicated one, which could happen. You can have private companies with unrelated shareholders, because private company related party shareholders, you don't have any types of property. It's like a public company scenario. It's like, you have related party butterflies and public company butterflies they're similar that way. But a private company where you have you and me were the shareholder, and we want to, let's say we want to spin off and we have division one and division two. We want to have more. Let's say the issue would be, let's say we figure we're going to sell division two sooner than division one. So we're going to we want to have different vendors for division 2 and we want to keep division 1. It's more complicated for us, which makes no sense. Just based on the fact that we got to divide the thing into 3 different buckets, and CRA is giving me a 1% deviation error, which is like, you may as well not give me any deviation error. And I think I laugh at what you said. It shouldn't be. I make a joke with people on my team. I said, maybe it will be 0. You may as well. Why are you giving me 1%? Just it has to be bang on, which with cash is difficult because it moves. So I hope, I don't know, I'm sorry, I know if I got a little bit technical, you can see I'm a little bit passionate to what I do, but you understand that, well, how does it work in simple terms? What the pressure points are, it goes to the point that this is too complicated for what we're trying to do. This is what I'm trying to say. It should not be so complicated. You shouldn't be spending so much money on a guy like me to do a corporate spinoff for a valid business reason. That's sort of what the point is. So I hope, sorry if I spoke a bit too long. And
Well, no, I find this is all very interesting. In the US, you mentioned they have a two-step approach.
Yeah. They have a 2-step approach for a spinoff. And what they do basically is they'll say, okay, let's say you have a parent company with a sub, right? And let's say the sub is owned by, let's say if we have parent co owning sub co. And simple example, we want to spin off, let's say you and I are the shareholders of parent co. And we want to have a situation whereby, I'm conceptual because this obviously applies in a public company domain either. I'm just simplifying it because you and me, right? That we're unrelated. So what the parent co would do in the US is say, okay, if we meet certain conditions, it'll just distribute the shares of subco to us as the parents. And so what happens is if we meet certain conditions in the US, so it's like a 2-step mechanism that first we distribute the shares, right? We distribute the shares to us. And then what we do is we cancel any intercorporate shares. So it's like a 2-step process we have, right? It's very easy. It's just a distribution it's like a distribution in kind of the subco shares from the parent to the shareholders, and the parents, and then the shareholders, if there's any sort of cancellation of shares, whatever, it happens immediately. So that's kind of like a 2-step process. And that's easy. There's no division types of property tests, right? Like we had in private company spinoffs. There's no like in these butterfly rules, there's things you can't do before, after, and during a butterfly. We don't have any of that. We have very straightforward rules with the US rules. Like one of the rules say that, okay, the parent has to own at least 80% of the sub for this to happen. Number one, the parent, you must be carrying on, parent and sub must be both carrying on an active business for 5 years. Both the sub's business that you're spinning off has to be carried on immediately after. I mean, I'm not a US expert, but I've dealt enough with these rules to give you the generalities, right? So the US sub has to be carrying on the same business after the spinoff. And more importantly, the best part about this, what I love, is you have to have a business purpose. If you don't have a business purpose, then what they're going to do is deem, when we do the distribution, like let's say it's really a distribution in kind from the parent company to the shareholders of the sub, what will happen is if it fails, if you don't have a business purpose, then the latent gain, or the built-in gain, like they call it in the US, of the sub will be taxed in the parent. And the distribution to you and me, in my example, will be considered a dividend to us. So it's punitive, but the rules are very like they kind of realize, okay, you got a business purpose. We understand you're just moving it from my left pocket to my right pocket, my loony. You have a good business reason for doing it. It could be for pursuing, a lot of it is pursuing different growth opportunities, whatever. We're not trying to be mischievous. We're not trying to divert profits or any of that stuff, which you have to show. It's a relatively more straightforward process than what I think. I mean, I know you're not a tax person. You're very smart, but you're not a tax, but you can see that way I was explaining the Canadian rules versus the US rules, because the US rules has it much more indoctrinated in their internal revenue code. It's more legislative based. The problem with the butterfly reorg rules, or the corporate spinoff rules, is the legislation on it scant. It's very little. The legislation on the actual butterfly rules, you guess how many pages it is for a corporate spinoff. You just want to it's like 4 pages. And basically they're telling you not how to do the butterfly, but not how to do, what the rules say is how not to do the butterfly, right? Versus the direct approach to the US, say, here's what you got to meet, the condition you got to meet to do the butterfly, right? Active trader business condition for 5 years prior for both parent and sub. Control, the parent has to have a control of 80% or more of the voting rights. You have to have a business purpose. This is all very straightforward to deal with. And that's like, if you want to compare the two, there's a difference for it. And that's why, again, but I understand, and France also, because I'm dealing with France, they're telling me the same thing. They're very similar rules in France, like not exactly the same, but it's sort of the same idea. It's like, hey, we're moving it from one bucket from another bucket from the same corporate group. It's very easy for us to do. And like, the French client I'm dealing with is like, I've never seen such complicated rules, and they're private equity in France. They have companies all over the world. I've never seen such rules as complicated as this, which we're talking about here in Canada. And that's sort of the reason why, right? Is that, remember, going back to what I said, there is no demerger rollover reorg provision in the Act. Like we have a merger provision under 87. This is more, it was initially basically, it's like, well, you know what? We're using it for another purpose. It's an exception to an anti-avoidance rule in the act that would convert tax-free into corporate dividend to capital gain. We don't have anything else that works. We're going to put this together, right? I'm not trying to insult finance, by the way, because I sit on the Joint Committee of Taxation where I work with finance. We're going to put this kind of together. It's kind of clunky. There's some risk involved, but it works. And this is the way it's been since 1981. Just to let you know. And now you're wondering why we call it a butterfly. I have to give you my little sense of humor this. Remember when I told you that in part of the Canadian rules that you have shares, that when you do the transfer, that you have one company owning the shares of, like the parent company owning the shares of another, the new parent company, and the old parent company is owning the shares of the other parent company, and there's a cross redemption. Well, if you just can imagine conceptually, and this was actually given in 1978, true story, where CRA was looking over this, one of the panelists for the Canadian Tax Foundation was looking over the slides of the CRA, and they were on John Street. They were honestly on John Street in the theater district having a lot to drink, and the guy was a little bit tipsy. The I'm not going to mention the name of the person. In 1960, he says, "Oh, the CRA guy, you know those cross redemptions you're talking about? Doesn't that look like the wings of a butterfly?" And the name stuck. It doesn't look like to be a butterfly at all, but I mean that's how you got those cross redemptions of cancellation of shares. That's how you call it. They said it looks like a wing of a butterfly. I don't think it does. That's how the name came up. So there's nothing technical when you use the word butterfly. Honestly, it's a bit sexier than using the word divisive reorganization or corporate spinoff, but that's kind of what it is. So I think I explained to you. I think I explained to you kind of how does it compare to the US, the friction points, and why is it in simple terms not so simple to explain what we do. So I hope I haven't confused you or your viewers, but I mean, it is an interesting field to be in.
Well, this is very helpful. So we have no demerger rules in Canada. It's scant, but a lot of this is what not to do.
Yeah, and the rules, and there's a lot of administrative concessions. The other problem you have is that CRA comes and fills the gaps, saying, well, if you want to do this, these are our administrative positions. And I know you're a lawyer, so you'll appreciate if you're doing a corporate spinoff, you don't want to rely on administrative positions from the government. You want to have law, right? Like it's clear, right? You just want to follow the law. Like people, like I said, there's nothing mischievous in the purposes I gave you for a corporate spinoff. You want to have the law because there's usually money involved in this, and if you screw it up, there's big money. So there's scant legislation, largely administered by CRA administrative fiat. So the big part of the spinoff we actually we're doing the spinoff. We did the $500 million. It was so complicated we had to go for a ruling. So what happened was in our case we had to go for a ruling with CRA that we had to work with them, and good thing we did because we actually uncovered more loopholes and more adverse tax, not loopholes, but adverse tax council laws that they had to rewrite the laws because of our butterfly. It was one of the largest actually done at the time when we did it. But imagine the time to do 2 years to do a corporate spinoff. It took us 2 years to get the approval from CRA because if we don't, then we knew they were going to get audited because it's huge amounts of money. But imagine the time and waste, like not to offend CRA, we worked with, they're nice people, but why did we have to do that? Why? Because there was too much uncertainty, the law being scant, lying on an administrative position. It didn't cover our particular situation because there's no law on it. So imagine the time and resources we wasted. The spinoff could have been done 3 years ago, 4 years ago, but we had to go through this process to get there, which again, government is really busy. I'm not against finance. I'm not against CRA. I work with them. Like I'm on the committees, as you said. They have better things to do than doing this, in my opinion.
Could we take the principles and the mechanisms that you've described in the United States and in France and import them into our law and make changes to our Income Tax Act to accommodate them?
Let's say the basic principle we're dealing with is to have a demerger provision, like a demerger reorganization, like an actual thing, like an amalgamation provision we have to have a demerger provision, right? A long time ago, I heard, I wasn't there. I wasn't practicing tax. I was only in high school then. They had proposed a demerger provision called 88.2. That's what I've heard from very senior people who I think are retired now, but it never went anywhere. So the idea has been there to do it, right? I just think like the thesis you quoted me, which I thank you very much, by the way, for doing that. It sat on finances, like it was proposed. So when it won first prize in Canada, it went to finance. People from finance read it and said, it's a good idea, but we have other fish to fry right now. And their view was, not to insult them, that we have other priorities to deal with right now. Your concerns are valid, right? And one of the things I propose in my thesis is introduce a demerger provision in the act, because that would simplify a lot. I mean, that would start getting you somewhere instead of relying on exceptions to an anti-avoidance rule to get what you want. So I think the answer would be yeah, if we can adopt a demerger provision which I'm not saying is going to be easy, that fits within our policy concerns that are different from, like, I'm using France as an example and the US. I know you mentioned US, but I'm using these two countries because they have different policy concerns. It would take time, but it's a missing rollover. It should be there because, like, it's becoming more and more common. Like, I deal a lot in this area with butterfly reorgs and stuff, but we deal with these issues. Like, I mean, we deal with a lot of this. This is, like, honestly 30 to 40% of my time spent in this area, which I told you, I can tell you, I'm just being policy talk. We're not talking fee generation from my perspective. It shouldn't be 40% of my time if we had a demerger provision. Does that make sense? Like, it shouldn't be spending, we should not be spending so much time on this. We have other things to do that to do something where, especially where you have a business purpose to it. So I think, like, I know, if you look at the US is based, their US tax is based on business purpose or economic substance. Canada was normally based on legal substance. So, like, we have to have legal substance. Like, we have to have, like, documents signed and whatever. So that's why in Canada, for instance, every corporation has to file a corporate return. Even if, let's say, Laura, you control the corporations, you control 6 corporations because they're legally separate entities. We can't consolidate it economically because we rely on legal substance. Now, the new GAR rules, the general anti-avoidance rules, have come in and they've introduced the concept of an economic substance in there. So I'm thinking to introduce this again with a butterfly reorg where we create a demerger rule. And again, one of the provisions, this is not complete. We create a demerger rule and we put a business purpose in there saying, look, you have to have a valid business reason to do this. I think it would simplify the anti-avoidance rules and all the that we have to do to circumvent to make sure that there's no mischief involved. It would simplify it tremendously, where, especially, like I said, there's normally a reason for a spinoff. There normally is a reason for it. You have a good reason usually for it. But yeah, I think it would be possible for sure.
Well, Canada's the national competitiveness of our markets has become a priority.
Okay.
How would simplifying these spin-off rules help with the competitiveness of the Canadian market?
I think what you would be able to do is make it more attractive for companies to get investors. Like, if, again, giving the example of the divisions, right? Like, the divisions are the best example, like Division 1, Division 2 in the same company. Making it more competitive, we have investors wanting to invest. And a lot of times when we do spinoffs, the other problem you have is when you do this, right? I can't I can't bring in an investor right away. I got to wait, like, from a tax perspective. So the one we did, I talked about, we had to do this 10 years before an investor came in. We were hoping, they were thinking it'd be 2 years. I basically told them, you got to wait 2 years before an investor comes in. So how would this help is that you would encourage investment, because a lot of times people want to invest in one thing, not another thing, or they want to, or let's say you have, give an example, let's say in the cleanup example where you have a bunch of investors, you have in one group, and then you have the same investors in the other group of companies. You want to spin it off from the dead companies into the new companies where potentially you have more growth opportunities in the US or whatever. This would just facilitate things. It's just basically, a lot of it is just, you're tidying up your garden. So I think, like, like, the thing is, like, it's if we have France, if France and America and US are telling me we can do it easily, then they don't have to wait. Because now, if we want to do the same thing in Canada, I'm telling, let's say, the French parent company, oh, but if you want to do a sale afterwards of this company, you got to wait 2 years. Well, if we were in the US or other jurisdictions, maybe we don't have to wait 2 years, right? So it basically, I don't think tax, I think how I make it better is that if we make a simpler system that's aligned with policy objectives, right? We shouldn't have the tax wave, like, what it shouldn't be the tax dog that waves the economic tail. It should be the economic dog that drives the tax tail, right? I don't know if that makes any sense. So
Yes.
I'm glad you find me funny. I'll let my wife know you find me funny. So I think tax it shouldn't be a driving factor. I mean, obviously when you're dealing with a transaction from vendor perspective, it's an important consideration because you want to minimize your taxes legally. But when you're trying to structure transactions and structure deals for investment, for growth, for various opportunities in your valid business, and they're valid economic reasons. We're not talking about shams. We're not talking about just tax avoidance and screwing the government in the system. I'm not talking about that. We're both professionals here. We don't believe in that. Like, you know, the tax shouldn't be the driving factor in an economic decision. That's my opinion, which is kind of funny because people look at me and they say, "Manu, you shouldn't say that because you'd be making less money." I go, well, we're talking policy here, right? That's what we're talking. And I mean, I know that people say that I should have been a lawyer like you because they say, well, most accountants don't like policy. They just like crunching numbers. I go, well, I think policy forms an important part of what the tax system is trying to achieve, right?
Yeah.
Because you have to drives, and you have to understand sometimes laws are changed if it doesn't align with the policy anymore, right? And I think if you're having a misalignment in a policy, if we're trying to foster international competitiveness, growth and economics, then we should have a tax system that facilitates that, not hinders it. Which, as you can see, again, I know you're not a tax expert, but now you can go to your family and say, "Hey, I know something about butterfly reorgs," and put them to sleep. I'm just saying, I'm just kidding about that. But you would appreciate the fact that we should not be using a system of corporate reorganizations that's a hindrance. And like I said, especially I deal with international corporate reorgs and butterflies. It's a really big, you could see that it's like, wow, like, why is this so easy for the French parent to give me an answer on a butterfly question from the French divisive reorg provisions or demerger provisions? It takes them a day to get back to me. With me, it takes me a week to get back to him with a modeling exercise. You understand? Like, it doesn't make any sense. I mean, we're doing it. He trusts me because we have all these issues to deal with, right? And like, it doesn't make any sense when you're looking at just these two countries. Now, I'm sure if we took a canvassing of surveys of other countries, because I'm looking at I can tell you France and the US, the other G7 countries, I'm sure would be aligned with more France and the US versus us, right? Because it's important. If I kind of answered your question? I think I have.
Yes. So, Manu, thank you very much for sharing these excellent insights. They've been extremely helpful. Thank you.
Oh, good. I appreciate it. Thank you for having me. And I appreciate your time. And thanks for inviting me to come on, and love to come back on again. So thank you very much.